So we are live now, Chad.
We are
Hello,
live.
hello to Seattle in North America, close to the Canadian border, right?
Yeah, close to Vancouver.
Close to Vancouver, exactly. And
Okay.
you're a dividend investor, like so many.
Right.
Okay,
So
that
this is an inaugural test stream for what we're calling right now Dividend Growth International.
exactly.
We are doing a test stream from StreamYard to a number of different destinations. Torsten is the manager of dividendstocks.cash and the German precursor to that. And I am the manager of Total Growth Investing, both on Facebook and on YouTube. And we are going to launch a discussion stream about international stocks and why people within the United States should not limit themselves just to stocks on the US exchanges, and perhaps the other way around as well. If people from the Eurozone or from Asia want to look for really good dividend-paying stocks for a long-term investment, we'll be talking about ones within the United States and outside the United States without limitations of borders. The
Exactly.
advantage, and we'll do some more introductions, but dividendstocks.cash is one of the best websites I've ever found to show the data about stocks outside of US exchanges, because Torsten does not go through intermediaries for the data. He gets it directly from the local exchanges in Euro. Do you want to talk a little bit more about where you get your data?
As you said, mostly from FactSet. It's our main data provider, but we also have another ones, different ones. And we always try to get the data like prices, the stock price from the original sources, from the main exchanges. And for us, it's very important to exclude the currency fluctuations from exchange rates. So if we do a fundamental analysis, we always analyze in the home currency, in the main currency. So for Tencent, for example, Hong Kong dollar, or Samsung from South Korea, South Korean won, and so on. And of course, we also have a lot of stocks from the United States, and we analyze these in US dollar.
Right. But so the reason, okay, the thing that we're going to run this test on is the fact that my total growth investing ranking data is currently showing Tencent holdings in China, I believe in Hong Kong, as the #1 stock. Now, for me, that's an ADR, but on the site dividendstocks.cash, it doesn't matter where it is. Like you said, you go with the original and native currency to see all the metrics. And so we're going to go through the metrics that you see on dividendstocks.cash for Tencent, just to show what kind of data that you have.
First, we can show your spreadsheet.
Okay.
Can you show it, or do I need to do something? Here it is. Huh?
There it is. So this is the Total Growth Investing stock ranking data sheet that I've been sharing for about 6 months. And at some point in a future live stream, we can talk about the history of it. You can also see that I've got video reviews that I'm putting out on my YouTube channel for a number of these. But here's the #1, Tencent Holdings. So this is the one that I wanted to talk about.
Okay, so I will show you now dividend stocks cash. I think anybody can see it. And
yes.
With the English version, we also have a German one. And the main product is the screener. And I'm already logged in probably, that's good. And it's just loading. And we have stocks from all over the world, nearly all over the world. And we have Tencent too. And this is the #1 stock. And you already see that we have a ranking of 100. That's already not a bad sign. But
so tell us about the ranking.
Value.
So I have my ranking list. How does your ranking system work to bring that up to 100%?
The ranking is individual. So I'm logged in as myself, and I have some personal preferences, and I use this personal, or I set up the ranking according to my personal preferences, and I mostly keep things simple. So what I did was mostly to focus completely on profit growth, quantified by earnings, cash flows, and even revenue, and anything else I turned off. So it's just about profit growth, and that's now why Tencent got a 100, and we will see how it this 100 was achieved, and this is it. So we have different criteria. I go back maybe a little bit fast. So we have these metrics like earning stability.
Hey, Torsten.
Yes.
Maximize the screen. It's a little blurry, so hit maximize. There we go. Make it a little less blurry.
Thank you. So I'm not trying to go too much into detail, but here we have the different sets of criteria. It's 1, 2, 3, 4, 5, 6. And we have all 6 criteria here. And you see that they all match, nearly all 100%, or except this one, it's revenue stability. But just to give you an idea about the quality of the stock there, you don't need the matrix because visually you already see, maybe we change the layout, that Tencent is a high-class company, because look at the earnings per share. They are already on the market for a very long time, Tencent, since 2004 at least. That's where we have data. Maybe we can even turn off the Zoom. Then we have data starting from 2003 for 17 years already for a tech company. That's a lot. Facebook, for example, is much younger. Just Amazon, for example, is a little bit older, but 2003 is already very old. And you see that each year we have an increase of earnings per share in Hong Kong dollar this time, because, as I said, we do fundamental analysis in the home currency, and here not in US dollar or something else, because this would falsify the fundamental analysis. Okay, and here you see the nice growth in earnings, in operating cash flow too. Here we got a little bit bumpy, but it's growing. Free cash flow, the same. You see also growing revenues on the level of the company, or the total level of the company. This is per share data. And Tencent is also a dividend stocks. And you see here dynamic dividend growth. And I think this makes Tencent a very interesting stock, and probably that's why it became number 1 on your spreadsheet, no?
I'll be honest, that is an absolutely beautiful graph.
Yeah. I took Tencent to discuss what is or to define what's a dividend stock, or to give people an idea that most people don't have really an idea what a dividend stock is. Many people think that AT&T, of course, it's a dividend stock, and they haven't postulated, but
Right.
in their mind, a dividend stocks need to pay a decent amount of dividends. So a dividend stock starts at 2%, 3% dividend yield, something like that. But in my point of view, that's not true. A dividend stock is a stock which reliably pays dividends. And even if dividends from the start are very low, if we have dynamic dividend growth, like in the case of Tencent, and you own this stock for some time, then you get a decent personal dividend yield. I can even show it to you here.
I mean, there's a difference between a dividend income stock, which would have a relatively high yield, maybe 4, 6%. That's where AT&T is right now, versus a dividend growth stock, which on a regular basis, on a regular interval, increases their dividend every single payment or every single year. Okay, so it's a differentiation between dividend income and dividend growth.
Exactly, and you need to know what you want, and so, because then you can set up your own ranking, and then you can find the right stocks for your own portfolio. If you say AT&T, for example, we can benchmark Tencent's dividend yield. That's the estimate of the future dividend yield, and we can benchmark versus AT&T. Right, where is it? Here it is. And then it's exactly what you said. The start dividend yield of AT&T is much higher. It's 6.8% even versus 0.26%. But in the course of time, AT&T's dividend growth is really lackluster, at least right now. And
Right.
that's where the estimates come from. And then we have this dynamic dividend growth of Tencent, and you see that Tencent really increases its dividend. And here, between 2035 and 2036, I admit it's not tomorrow, it's a little bit longer away, but we'll have this crossover anytime in the future. And it's really probable that this will really happen. And if you keep this stock, Tencent in this case, just long enough, then you will have a dividend yield maybe in the future, which will be even double digit. But that's unimaginable for people today.
There's something important to mention here too. The current yield is different from yield on cost. What we're looking at with the Tencent numbers there is potential yield on cost, not current yield. So Tencent might keep their current yield below 1%, but if they keep growing their dividend, it will catch up and exceed the AT&T yield on cost between 35 and 36, and then keep going from there. You know,
exactly.
For so many people, the current yield is so easy to use as a benchmark, and that's not the best benchmark to use. And I keep preaching this in my live streams and in the articles that I post and the comments and things that I make. It's like, don't worry about current yield. Look at dividend growth, because this is a perfect example of a high yield stock, AT&T, with low growth being completely crushed after 15 years. And if you're a dividend investor, you're investing for the long term. At least you're investing until the point where you need to retire and switch over to a different strategy. This is a really good example of two different strategies. The dividend growth strategy focuses on the stocks that will grow over time. The dividend income strategy means you need that cash now to pay your bills.
Exactly. And there's also a second dimension of this, because many dividend investors forget that their yield is not only coming from dividend payments, but from capital gains as well. Yes. And someone did a comment in German, but I will translate that maybe this dynamic dividend yield somewhere in the future will stop. It's possible. We don't know. We don't know the future, but it's more probable that Tencent will increase its dividend more dynamically than AT&T will in the future. And so this is just a scenario, but with a certain probability. But I wanted to say that there's also the dimension of capital gains. And this is also very important, because it's part of your overall yield. And if this scenario will happen, or a similar scenario, that means you can't see it here, but it means that AT&T's capital gains will be very low, while Tencent's capital gains will be much higher. And this adds to the overall yield you might expect. And it's a huge argument for growth investing versus income investing.
In my opinion, you want to focus on growth investing while you have the time to do it. If you're investing for more than 10 or 15 years, dividend growth is what you should be focused on for this reason. Exactly. And for new people coming into the market now in their 20s and 30s, focused on stocks like AT&T or Southern Company or all of these other medium to high current yield stocks, it's really confusing because they have so much time to be able to build an incredible portfolio, and they seem to be wasting it thinking that they're getting more from a high yield stock. It's just not true.
Just I'm reading some comments here, and
Yeah.
some people do criticize that we look too far in the future, and that there are political, how do you say,
Political uncertainties.
tensions, uncertainties, and that you can't predict something like this.
That's
I
very
agree.
true.
Yes, we both agree, Chet and I. This is just take it as a learning example. I think that is very good because these two stocks are very, very different characteristics. Take it as a learning example.
Looking beyond the estimates that we have on file is honestly just a math exercise. So we're just looking at the results of a math problem here. But let's go to valuation and actually look at what those estimates are.
Exactly. Just one more thing about one more dimension about investing versus growth. I think we are now in a market period where stocks like Tencent, it's a tech stock, are highly valued, at least in general. I don't know if Tencent is. We will see it right now. While dividend income stocks mostly are valued much lower. Think about the REITs, for example, like Realty Income, or maybe also AT&T, and this makes stocks or dividend income stocks more attractive, I think, to many investors.
Another thing to note about that comparison is that AT&T is a telecommunications company in a very mature market. So their payout ratio is pretty high because they've already expanded up to the limits sometimes of what they can do, and they're focused on maintaining what they've got. Tencent, as a growth company, is going new places all the time. They are expanding in China and around the world with whole new industries and entirely different markets. So it might not be a fair comparison between the two, but like we said, it's just a math problem to see what the comparison was.
Exactly. And now we can take a look at the evaluation of Tencent. And Tencent is rather easy to evaluate. So we can even just give me a little look about the valuation matrix to find the right time frame. I will start with here. And then let's just, that's the stock price. And you here see, you can also change to logarithmic. And you see that the best time to buy Tencent was in the far past.
Yep,
but we still
usually true.
We still have exactly. We still have an annual yield starting from 2004 of nearly 50%.
Oh my gosh.
Yeah. Okay. Why didn't we invest, Chad? Okay, and that's now let's take a look at the valuation of that one. You can also add fair value dividend, but it doesn't make a lot of sense. It fits the fair value dividend. You can already see it here, but no one is buying Tencent because of its dividend.
No.
We are honest, huh? Even if we get a double-digit yield in 20 or 30 years, I don't remember when it will be. No one is buying Tencent today because of its dividends, so get rid of this. And then we zoom a little bit more, and here you see the valuation. And what's very nice, I own Tencent. By the way, I bought Tencent somewhere here, if I remember well, in the beginning of 2017, and then I was happy because the stock really went off. You see it here. The stock really went off, but it was also went into really overvalued territory. And then I still remember some problems appeared with the Chinese administration. They stopped licensing of new video games. And if a company is overvalued so clearly, so high, and any problems arise and the stock price comes back, and that's exactly what happened.
Yeah.
But at least now you see that Tencent, the stock price came up once more. It's overvalued again, but fundamentally, there is a fundamental reason because earnings and cash flows increase it as well. So when I bought Tencent, it was worth about 180 Hong Kong dollar, and now the fair value is 420 Hong Kong dollar. You can connect these dots here, and then you see that the increase of the fair value of Tencent is about 30% per year. That's less than the long-term increase we have seen of the capital gains. It was close to 50%, so
Right.
it nearly halved, but it's still very high for a stock which could be called mature, because it's really an old stock, Tencent. So it's a number one stock on your spreadsheet, and I think it's really a high class stock.
So where is it going to go according to the estimates?
Let's see. Higher.
Higher yet.
So the fair value will something between 620 and close to 700 Hong Kong dollar. Right now we are 520 Hong Kong dollar. If you zoom in a little bit more, then you see it more precisely. Then we have these valuation lines, and now we can try to determine our expectation of our overall yield if we buy Tencent today. That's this red dot here, and the fair values are somewhere here between. If we add the fair value dividend, it's even higher. But as I already said,
Well,
get rid of
one thing. I mean, bring that back really quick, because that harkens back to the dividend expectations, the dividend growth expectations.
Exactly. So we have estimated dividend increases here and here once a year. They should happen. They at least do it in the model like that. They are based on broker estimates collected by FactSet.
Yep.
But let's get rid of this. And if we now want to determine our expected capital gains or expected overall yield, dividends included, then we can something like that, somewhere in between the middle. Fair values are only estimates. This is a true fair value. This is the wrong one. One fair value is more plausible than the other one, maybe, but these ones are really close together. So we have an annual yield of only close to 10%, 9.2%, which is far below the historic yield. And why is it so low? It's not because Tencent is not growing anymore, but it's because Tencent today already seems to be overvalued. The stock price is already expensive. So Tencent needs time to grow first into the current valuation of the stock, and then to pass behind the current valuation of the stock.
Right.
That means your expected capital gains are negative in the short term. So expected
if it comes back down to fair value, yes.
Yeah, if something happens like it did, let's zoom back. If something happens, again, some bad news, like in the beginning of 2018, and the stock is overvalued, like today, then you will have to, and then you might expect capital losses even, but only in the short term. If estimates still hold true, like this one.
Right. Well, and this is also only looking 2 years into the future, because that's as far as the official estimates can go.
The FactSet estimates, I have even estimates for stocks like Tencent, which are covered very well. There we have estimates even for a longer period, but for many stocks, we only have estimates for 2 years, for example. The problem is also that the longer you go into the future, the less brokers collect estimates, or the less estimates we have. And then it's a mathematical problem, because when some brokers disappear, the average or the mean values, they change. Because if you have a very optimistic broker, for example, and he goes away, then the estimates will be lower for the remaining years without the company having something happening something bad.
Okay.
You know, it's a mathematical problem or somewhere, and that's why I don't want to show the estimates in the future too long.
Understandable. So I want to make a quick comment here. A broadcast has been successful when it attracts people who want to post spam. So we just got our first official spam message. So thank you very much, Brian. That means we know that we're successful and we're reaching enough people. Great, thanks.
Okay, maybe do you still want to say something about Tencent?
Excuse me, just a second. Go ahead.
Because otherwise we can say that we want to create a series, and once a week we want to publish this live stream, and during the week we invite you on all our channels to give us an idea about what to talk, either interesting stocks or general something in general about the current stock market. Yes. Anything you think which should or could be interesting for long-term investors. We are all long-term investors here, and it doesn't matter if it's dividend income, dividend growth, or if it's even about stocks maybe which don't pay dividend at all, because maybe anytime in the future they will start paying dividends if they are successful. So we just invite you to drop comments, and then we will collect these comments, and we will create this weekly live stream, always chat and me.
Yep.
Agreed?
Agreed. So this was just supposed to be a quick test, but there is so much to say about how well Tencent is doing and the kind of metrics that we can show on dividendstocks.cash. If you want to share mine again, I can go over a little bit more of the total growth investing ranking list. I can show you why it's number one. So this list breaks down 3 different categories of data. Okay, I grabbed the dividend growth ranking for 4 different time periods, 1, 3, 5, and 10 years. And then I rank those for each of those year categories, every stock against each other. I'm not comparing against an arbitrary number. I'm not looking for a certain amount of growth. I'm just comparing to see which ones are above others. And then I grab the average of the ranking numbers, not the percentage numbers. That's an important distinction. So the average ranking here is the average of these 4 numbers, and that helps me build my ranking list. The second set of numbers that I use are price growth. Same time periods, 1 year, 3 year, 5 year, and 10 year. And you can see the 10 year just price growth for Tencent has been 1,873%. That's just price.
We have the same information on dividend stocks cash too. Huh?
Right.
Exactly. Yeah.
And you have 15 year as well. And these are the ranking numbers for the price performance. This is the average of these ranking numbers. And then I pull in one last piece of data back here, and that is there it is, the payout ratio. Okay. The payout ratio for Tencent right now is 10.59%. That is, to be honest, extremely low. That means that this company has an influx of cash revenue that they are putting into growth, not just sending out to shareholders. If we go down a little bit further here, here's one, MSCI, one of the financial exchanges. They are sending out 38% of their revenue back to shareholders, and that's cutting into their growth a little bit. anyway, getting back to Tencent. So we've got those three rankings. We've got dividend growth ranking, we've got price growth ranking, and then we've got the payout ratio ranking. And I combine all of those into an overall total growth investing ranking average. And then I rank this column. This ranking score over here, where Tencent is number 1, is the rank of those average rankings for all the other categories.
Mhm.
It's a little complicated, and it gets a little more complicated than that because I give an advantage to the 1 and 3 year categories, thinking that I want to catch things quickly when they move fast. But anyway, but there's also more information over here that I'm working on, but this total growth investing score is how I order what I buy when I buy it.
Chat, I think what my people interest is this spreadsheet available to anyone?
This is a public document, yes.
Okay, so we should post the link somewhere, maybe.
Yep.
But
well,
we
if
can
you go on Facebook to the Total Growth Investing page, which I will bring up right here after I close all the chat windows.
We can also add the link in our announcements.
Yes.
Maybe. Mm-hmm.
So here's the page, Total Growth Investing, and here's us. And the pinned post on this page is a link to this ranking list. So anybody can go to this list and see what stocks are on it and do a search. And I've got other resources that I've built on top of this that we will be showing over the next couple weeks.
And it's all available for free, right?
Yes.
Okay. So we will go back. Here we are. And I want to say about Tencent, just to give you an idea. We have a blog, and we also do analysis. And we also analyzed Tencent already. We have here these analyses. We also have these analyses in German, and here we have the analysis about Tencent. So if you want to know what to dig a little bit deeper into Tencent, then you can read this one. It was all our analyses are written by Seeking Alpha authors, by the way. And here you get a pretty solid idea, I think, about Tencent. Okay, that's just that this possibility exists if you want to dig deeper. So, chat, I think it was good, our test session. Thanks to anyone watching there. I hope it was interesting for you too.
We've been getting a lot of comments.
Yeah. Thanks to anybody. We will post this announcement on all our channels about the next live stream, and there we will also ask any one of you to post your questions and your ideas about the next live stream, about what to cover. Right?
One quick note on where we're doing this. Right now, this broadcast is going to a whole bunch of different locations. It's going to Acton It's going to dividendstocks.cash, both Facebook and YouTube. It's also going to Total Growth Investing, both Facebook and YouTube, all simultaneously.
Yeah, it's international like we are and like our stocks are.
Right.
Okay, then thanks to anybody. Happy to meet you again. And have a nice time.
Okay.
Bye-bye.
We'll see you everybody. We'll see everybody next week.
Okay. Ciao.